Assalamualaikum warahmatullah and good morning. This is the second part of our lecture videos on the topic of complete accounting cycle for service business. Okay, so the second part we will be looking at preparing the financial statements from our worksheet. In the previous video, we have looked into how to prepare our complete worksheet. So like I said, the worksheet is a blueprint, a draft. It shows a draft of all the accounts, the trial balance, the adjusted trial balance, and the income and balance sheet, income statement and balance sheet. So the next step is to prepare the actual financial statements based on what we have drafted in the worksheet. Okay. So it says here, income statement is prepared from the income statement columns of the worksheet. Okay, we have looked into, there are several columns in the worksheet, and income statement column is one of them. And balance sheet and owner's equity statements are prepared from the balance sheet columns. Okay, so the balance sheet columns, we will use the balance sheet columns to prepare two statements: the balance sheet as well as the owner's equity statement. Okay, we will show how to do that. And companies can prepare financial statements before they journalize and post adjusting entries. Okay, since we already have a drafted balance sheet, a drafted income statement out of the worksheet, okay, so we can actually prepare all the financial statements before we do the adjusting entries. Okay, we will talk about that one later, but what we want to do now is to prepare statements from a worksheet. Okay, so if we just look back into the worksheet, what we do is that to prepare the financial statement, we just take all of the items, all of the balances of the accounts that we show in the income statement columns. Okay, we enter into this statement. So this is the income statement. So just let us try to look back at the okay, alright, so this was the worksheet that we have prepared. Okay, so what we need to do is we take all of the balances from the income statement column. Okay, we have this column, so we take all of the balances. We have service, we have this from the service revenue. We have 5,200 of salaries and wages expenses. We have 900 of rent expenses. Okay, we have supplies expense 1,500, and so on and so forth. So we have this revenue amount, and we have all of these expenses amount. So what we need to do is we need to prepare the income statement. So we have in our income statement, we put in the name of the company. Okay, Pioneer Advertising. So that's the first the header. You can say this income statement, there's a header and there's the body of the statement. Okay, so this is the header of the statement. The header of the statement contains firstly the name of the company. Secondly is the name of the statement. So this is called income statement. And thirdly is the period. Okay, so income statement shows the performance of the company for a certain period of time. So we should say the ending period. Okay, so for the month ended. Okay, so this income statement is prepared to show the performance of the company in the month of October. Therefore, what we should say is that this is an income statement for the month ended October 31st. Okay, if we are preparing an income statement for the whole year, a yearly income statement, and coincidentally the ending of the year, the fiscal year ends on October 31st 2017, then what we should say, we should state this as income statement for the year ended October 31st 2017. Okay, if this is a quarterly statement, okay, 3-month statement, okay, a quarterly statement, then we should say income statement for the quarter ended October 31st, 2017. Okay, but in this case, it's a monthly statement. So all of these information here shows the balances of the accounts for 1 month transaction. Okay, not 1 year, but 1 month transaction. Okay, so the top in the body of the income statement, the top part should be the revenue. So we should list all the revenue. So this is the title. This is the header. The title. Okay, revenues is the title, and then this is the account, service revenue, and the balance is 10,600 we obtained from the worksheet under the income statement column. And then after we have the revenue, okay, we have only one revenue here. Then we populate the expenses. Okay, we write the title here as expenses, and then we list all of the expenses. We have 1, 2, 3, 4, 5, 6 expenses. Okay, we have the salary and wages expenses, supplies expense, rent expense, all of this. So we write the total here a little bit in the middle. Okay, and then we total up all of the expenses. When we total up, we put into the same column as the total of the revenue. Now we can we have total revenue of 10,600, and we have total expenses of 7,740. We put an underline before that underneath here, so that we will total up. Well, actually not total up, but 10,600 minus 7,740. Okay, the revenue minus the expenses, and we have a net income. So you write here net income, and this is the difference, okay, of 10,600 and 7,740. So the difference is 2,860, and we put a double underline here. That's the final figure, or in other words, we say this as the bottom line. This is the bottom line of the income statement. Okay, so that's how we prepare our income statement from the worksheet. Okay. Next, we prepare the owner's equity statement. Okay, so how do we get the owner's equity statement? Okay, again, we obtain this from the worksheet. Okay, so but before we obtain this from the worksheet, we need to know the beginning balance of the owner's capital, because the owner's equity statement shows the beginning balance, or the changes to the owner's capital. So when we want to show the changes, we should show what is the beginning balance of the owner's capital and what is the ending balance of the owner's capital. Okay, so the owner's capital, based on the previous example in our previous lectures, the owner's capital for Pioneer Advertising on 1st October is 0, because it started without any balance. Okay, the business has just started. So on 1st October, there's no balance. But then there's investment, okay, of 10,000. We know that there's an investment of 10,000 because in the worksheet there's a balance of 10,000. Okay, and we know that the Pioneer Advertising, when they started business on October, they don't have any capital yet. Okay, so the difference between the ending balance of owner's capital is the investment. Okay, 10,000. And then net income. So net income comes from the balance sheet column. Okay, here. Okay, so if you see income statement here, income statement column, you have that one, 2,860. This is the net income as shown in the income statement, and this particular balance is transferred to the balance sheet. So this balance is actually what is taken and put into the owner's equity statement. Okay, So this 2,860 that is entered into the owner's equity statement. Therefore, if you go back here, right? So net income comes from the that net income row under the balance sheet column. Okay. So next we list the drawings. Okay. So if you see investments relate to all the credit side of the balance sheet. Net income is also related to the credit side of the balance sheet, but drawing is related on the debit side of the balance sheet. Okay. So here the balance is showing a credit side. So if it's a drawing, then it's a drawing is a debit account. Therefore, it is a reduction in the owner's capital. Okay. So if you look back here, net income we actually add to the owner's capital, but drawings we minus from the owner's capital. Why is it that way? When we look back at the worksheet, okay, if you look at the worksheet, the net income is on the credit side, therefore it adds to the owner capital, but the owner's drawing is a debit side on the balance sheet, therefore it is a reduction from the owner's capital. It is reducing the owner's capital. Okay, right. Okay, so that's the owner's equity. So we add net income to the owner's capital, and we less the drawing from the owner's capital, and we obtain the owner's capital of 12,360. Okay, there's the owner's capital to 12,360. And finally, we prepare the balance sheet. Okay, so the balance sheet again, there's the statement itself has a header, and then the body of the statement. So the header will have the title of the company, the statement name, the balance sheet. But for balance sheet, we say it is a balance sheet as at 30th October 2017, because it's a snapshot of the position of the company. It's not showing a performance, a one-year performance, but it is showing at this particular date, at October 31st, on that exact date, how much is the cash, how much are the liabilities, and how much is the owner's equity. Okay. So here we will take all of the asset accounts. Here we will take all of the liability, and here we will have owner's capital is based on. This is taken from the owner's equity statement, which is 12,360. But the rest of the items comes from the worksheet on the balance sheet column. So we go back. So we go back to the worksheet. All right. Okay. So if you look at the worksheet. If you look back at the worksheet, we have on the balance sheet column, we have the accounts listed with their balances on the debit or credit side based on the type of accounts. So we have all the asset accounts, cash, supplies, prepaid insurance, and equipment. We have the balances on the debit side. We have the liability accounts, notes payable, accounts payable, unearned revenue. Yeah, on the credit side, we have the owner's capital. Okay. On the credit side, and we have the other things as well. Accumulated depreciation. Okay, accumulated depreciation is credit side, but it is actually a fixed asset account. It's an asset account, but it's a contra asset account, because the original asset account is equipment. The accumulated depreciation is a contra to equipment. Okay, like we have mentioned in one of our lectures before. Okay, receivables, account receivable is an asset. Interest payable is a liability. salaries and wages payable is a liability. So we transfer all of these amount, not all. We don't transfer owner's drawing, because the owner's drawing we have already transferred this into the owner's equity statement. Okay, we have transferred this one into the owner's equity statement. The 10,000 owner's capital is reflected in the investment amount in the owner's equity statement. Okay, and this net income is entered into the owner's equity statement, but the rest, the asset and the liabilities, will be inserted into the balance sheet. Okay, so from all of this, we will the asset and the liability balances we will transfer into our balance sheet. Okay, here. Okay, so we have our cash, we have our assets. So firstly, we list all of our assets. We put a header here, we put a title here, asset. We list all of the assets, and then we have equipment. And like I said before, there's the contra account, the accumulated depreciation. So equipment, we need to minus our accumulated depreciation, and we will obtain our net book value of our equipment. So this is the net book value of our equipment here, and we total out of all of our assets, we come to 21,910. And then the other side of our balance sheet will be the liabilities and the owner's equity. So if you see, this is similar to our in our first lecture, our accounting accounting equation. Okay, we have asset equals liability plus owner's equity. So we have the asset on the top side of the balance sheet, and we have liabilities and owner's equity on the bottom side of the balance sheet. Okay, so we list all the liabilities first. Okay, we have a title here, liabilities. We list all of the liabilities: the notes payable, accounts payable, interest payable, unearned service revenue, salaries and wages payable. All of these figures we obtain from the worksheet on the credit side of the balance sheet column. Okay, so we total up the liabilities. We have a total of 9,550 total of liabilities. Okay. And then we have the owner's equity. So what does the owner's equity consist of? It consists of owner's capital, and owner's capital we obtain from the this from our owner's equity statement. The ending balance of the owner's capital, 12,360, is taken from the owner's equity statement, and it will be entered into the balance sheet under owner's capital. So owner's capital as at 31st October is 12,360. So when we add the owner's equity with the total liabilities, we will obtain 21,910, which is the total liabilities and owner's equity, and it should equal with the total assets. Okay, after we have prepared the financial statements from our worksheet, next we will do our adjusting entries. Okay, so previously or conventionally, if we don't use a worksheet, the flow of the work is that after we have prepared our accounts for all of our transactions, we prepare our trial balance, and after preparing the trial balance, we need to do the adjustments and update all of the accounts by performing the journal entry of the adjusting. Okay, the adjustments, we need to do the journal entries for all of the adjustments so that they will update the accounts, and from there we prepare the adjusted trial balance, and from the adjusted trial balance we produce the financial reports. Okay, but since we have drafted all of these things inside the worksheet, therefore we can prepare our financial statements even before we prepare our adjusting entries. because all the figures or the balances of the accounts have been drafted inside the worksheet. Okay, so here is adjusting entries are prepared from the adjustment columns. Okay, so when we use a worksheet to prepare the adjusting entries, we can refer to our worksheet. And it says here, generalizing and posting of adjusted entries follows the preparation of financial statements when worksheet is used. When we use worksheet, we have the option of delaying the posting of adjusting entries. Okay, even after we prepare our financial reports. Okay, financial statements. Okay, we can do that. But if we do not prepare a worksheet, then we need to do the adjusting entries before we prepare our financial reports. Otherwise, when we carry on the balances from our trial balance into our income statement and balance sheet, we will be bringing in some of incorrect or unupdated balances. Okay, right. Therefore, we prepare our adjusting entries from our worksheet.